Right here in Chapter 8, Part B, looking at contingencies, things that may happen. Okay, so contingent liabilities, uncertain situations that can result in a gain or loss, we just don't know. And a contingent liability, existing uncertain situation that might result in a loss specifically. For reporting a contingent liability, the payment needs to be probable and the amount needs to be reasonably estimable. Tricky word to pronounce. There are other categories of things when thinking about how likely are we going to pay this thing, like in a lawsuit or something. Probable, reasonably probable, or remote. It has to be probable. And again, very much open to interpretation. If management believes this is probable, it's got to be recorded. And if the amount is reasonably estimable or estimatable, as many might say, when both of those things occur, then the contingent liability needs to be reported. If not, then it's not going to be reported. Here it is in a table. If it's probable and reasonably estimable, then need to record it. So this $100 million lawsuit, loss, contingent liability, then it still might not come through, right? But we're at least going to record it because it is probable and reasonably estimable. It's a note from United Airlines. Company records liabilities and legal environmental claims when a loss is probable and reasonably estimable. There you go. Warranties, a very minor, kind of smaller scale contingent liability. Warranties that are sold are probable and reasonably estimable. We've sold a warranty, and you can create an estimate based on past experiences, industry statistics, other conditions on what that amount might be. So it could be estimate warranty cost estimated at 3% of sales. Last year, $1.5 million in sales. So make adjusting entries of warranty expense and warranty liability in that amount. Then when those claims are made in the future period, the entry would be warranty liability and cash when those warranty claims are recorded. And there could be other nuances with warranty, either replacement parts or something, but just for the concept, reducing the liability and reducing some form of an asset. Okay. A common mistake, think that the balance in the warranty liability should equal the warranty expense. Not true. The liability account is increased when the estimated liability is recorded, but reduced over time when actual warranties come through. Now, contingent gains, we want to be a bit more conservative with these, right? Because we don't want to overstate what gains we might have as a company. So like in a lawsuit, would only be recorded when the gain is known with certainty. And that's going to be typically after a judgment has been rendered and you're now trying to collect on that gain. But it could happen right at the end of the year and it looks just overwhelmingly certain, but it's certainty. So it's pretty high bar. Yeah, not recorded until the gain is certain and no longer a contingency. Okay, and then another aspect here on liabilities, looking at liquidity using current liability ratios. So 3 liquidity ratios helping us understand whether companies have sufficient cash or other very current assets to help pay for currently maturing debts. And previously talked about balloon payments and the current portion of long-term debt. If that current portion of the current portion of long-term liabilities is really high, you better have current assets available to pay those current liabilities. And this is what, again, investors and creditors are going to look at is the liquidity of the organization. So working capital, current ratio, and acid test. That's always a fun one. The asset test. Working capital is just current assets minus current liabilities. It's the working capital. What do you have left over? That's going to include all the AR, all the inventory, all the cash, all the other current assets, prepaid, different things, all the assets. Large positive working capital is an indicator of liquidity. not the best measure of liquidity for comparing companies to each other. Certainly not helpful from outside industries, but within the same industry, it'd be a little bit more meaningful because you have the same type of industry conditions that you're dealing with. Okay, but that's working capital. Current ratio is current assets divided by current liabilities. So the difference there is current assets minus current liabilities for working capital. Current ratio, assets divided by liabilities, current. Current ratio of 1.5 indicates for every dollar of current liabilities, the company has $1.50 of current assets. So that's good. Now the acid test ratio, like really getting to the heart of it, I think the idea is that you're burning off everything else and getting down to just a smaller set of smaller ratio of quick assets. Right, for every what is that the level of quick assets for every dollar of current liabilities. So this only includes cash, current investments, and accounts receivable. So it's excluding things like inventory and prepaid rent, any other long-term assets, right? So cash, current investments, accounts receivable, things that you could convert to cash very, very quickly in the case of an emergency over that current liabilities. If that's negative, you're in trouble, right? You're relying on um, people to pay on their accounts receivable or for customers to buy. And of course, we're always relying on customers to buy stuff, but it puts companies in a precarious situation if their acid test ratio is not above 1. Very important that it is. So there's a summary of those three things. In general, current ratio is better, of course, but it's not always a good sign, right? The current ratio could be the result of really high levels of accounts receivable, right? That would create a high level of current assets, and that's not really a great signal. Or it could be a really high level of inventory, which is not necessarily great. If it means that the inventory is not being purchased, that there's a low turnover inventory turnover level, right? The customers are not coming in very quickly. So it needs to be a balance there between the two, and a closer look. Seeing the ratio number is good, but then take a closer look how it's being generated. So effective current changes, some changes on current ratios and acid test ratio. Just look at this column. Changes that increase the ratio for the current ratio, increasing current assets, decreasing current liabilities. But for the acid test, in the increase in quick assets, so it's cash, AR, quickly convertible cash equivalents, and then decreasing current liabilities, and then just the opposite for things that decrease that ratio. Now, liquidity management can influence the ratios, right? And there can be some kind of funny business here with delaying shipment and billing of certain inventory parts to either increase or decrease inventory, right? Posting the collection of accounts receivable, different things like that. Yeah, so I mentioned before, we've seen examples of closeout sales, right? Inventory reduction sales, trying to get rid of that inventory, but then it's also going to affect the current ratios and quick ratios and acid ratios. So here's an example for current ratio that's $5 million divided by $4 million of this current debt's 1.25 for the current ratio. However, the debt covenant requires a minimum current ratio greater than 1.25. So if they delay $1 million of inventory, it's delayed till early January. The inventory and accounts payable will both be lower by $1 million. So the current ratio increases now from 4 million over 3 million for 1.3. So the debt covenant is required. And debt covenant, that idea, just that your creditors, they may periodically check at the end of the period or more frequently, what's the debt level? And if they see that debt level or the current ratio dipping below 1.25, they're going to say, oh, you're no longer a good risk for us, we're going to demand that our debt is paid sooner. That's what the idea of a debt covenant. You have to meet certain obligations to remain in good standing with your debtor. Okay, another example here, starting current ratio, currently less than 1. So current ratio 3 million current assets and 4 million current liabilities, 0.75. So the debt covenant requires that it be greater than 0.75. So the impact of receiving $1 million of goods that's delayed until early January. The inventory and accounts payable both lower by $1 million. 2 million current assets, 3 divided by 3 million current liabilities, 0.67. Debt covenant requirement is not met. Okay. Or impact of the purchase of $1 million of additional inventory on credit, inventory and accounts payable are both higher by $1 million. So the current ratio is 0.8 and it is met. So there can definitely be some management of these ratios, paying careful attention to what is required, what's expected, what investors are looking at, what creditors are looking at, all part of it. And that is the end of this bit on contingent liabilities.